Hi, everyone. It's John. It's time for a general market update. It's February 17th, 2023. Again, the presentation's by Rain King, LLC, and I am an amateur growth stock investor not affiliated with MarketSmith or IBD. So our agenda today is really threefold. We're going to talk about market sentiment, which we haven't talked about in a while. Then we'll do an update on the pullback in the indices. And then we're going to revisit this idea of how important it is to watch your average cost. So market sentiment. On the left, this is the AAII sentiment survey, which is really retail investors being surveyed every week. I'm pointing out a couple things. Back on February 2nd, or excuse me, February 1st is when we had still had bears in red outnumbering bulls. The following week is when the bears reduced and the bulls started to increase. Use this indicator sometimes because the retail crowd is usually wrong at market extremes. You'll notice that the current pullback we had started February 2nd, right as this shift began. It kind of is indicative of retail investors finally being convinced that the market's going to rally when it had already been rallying for at least 3 weeks. So the crowd tends to be late. If you look at the net number, which is the net number of bulls minus bears, it hasn't been a positive bull number in quite a while. You'll notice it goes all the way back to the market top of the market back in November of 2021. So it's actually a welcome sign to see that the bulls are starting to pick up, and we'll see where it goes. This is the National Association of Active Investment Managers, their exposure index, which is a 2-week moving average of their exposure. Kind of put these color-coded zones, which typically correspond with what's going on with institutions. When institutions only have exposure of 10 to 20%, very defensive, it tends to mark market bottoms. And you'll notice that it occurred way back in middle of May. It touched the 20% line, and then we really dove down in October. And as we all know, the current low of the market is October 13th. Since then, they've been deploying some more of their money into the market. And we've risen back up to exposure levels somewhere in the 80% range. We've seen this on the charts. We've seen the subsequent follow-through days. We know that institutions are putting money back to work. So on the breadth side, New York Stock Exchange breadth, this is the New York Advanced Decline line on the left. You see that we've broken a significant downtrend since we had the bear market throughout 2022. Now, the advanced decline line is great at measuring the direction, but we also want to look at stocks above the 200-day or perhaps above the 50-day moving average, because that indicator really shows us, takes into account the price change and the direction of that price change. So we've seen thrust we had in January get us to above 70% above the 200-day moving average, which is really good. That's usually a level that is associated with bull markets. So let's go back to our update on the pullback. So last week, I outlined some of the things we were going to be looking for. You can pause your video player if you didn't watch last week's video. But the main point is we're trying to understand, is the pullback normal or is the pullback abnormal? And we're trying to see, is the market coming back in gently and crouching before another leg up? Or are we getting some very much abnormal action, like touching a hot stove? And these are the things that we were looking at. Now, we had the thrust signal back on January 12th, and we have some data to look at the first 6 weeks. The first 6 weeks of that thrust would take us to the end of February. And 3 to 5% pullbacks would be completely normal based on historical data. So let's take a look at the month of February. Now, it's not unusual after a very strong January, we had the January trifecta, that things would cool off and pull back in February, and that's what we've seen. This chart came from Ryan Dietrich at Carson, and what's particularly noteworthy is the second half of February tends to be not a good time period. So we'll have to see how it plays out. I remember in 2016, late February was a very bad time because we were in very much of a sharp correction. So let's see what happens. but it's not unusual for February to be a pause, pulling back and consolidating after a great January. This is the chart that I had that was some markers on it, some signposts that we were using to help us guide us. We had said that we were coming back down, pulling back, and we're about here in the S&P, about a 3.5% pullback off the recent highs. And we had said to ourselves, if we came all the way down even to the 200-day moving average, that would be about 5.8%. Still very much in the land of being normal pullback, particularly if we got support above the 200-day moving average. That would all be very constructive. So things still look okay, though it is a stock picker's market. On the NASDAQ, we've noted numerous weeks now all of the accumulation days in green. Very strong sign when you have this much accumulation day after day, sometimes back to back. We did get some distribution the last 2 weeks in the pullback, which is normal. Not huge distribution, but it's there, particularly in some groups. We'll talk about maybe where the action is and where it isn't. Recording this right around the market close on Friday. So you can see here, I believe it came down. We touched the 20-day moving average, and we seem to get some support. So last week, I pulled a handful of leading stock names, and my notes are on the left here. I've kind of updated those notes on the right in the box. If you just do the squint test, you can see that on the left side, there are not that much red, and there's a little bit more red on the column here on the box on the right. Not huge, but you definitely can hit some highlights. The semiconductors are still holding very, very well, strong, above the 20-day moving average, still acting well. There have been some blow-ups or plunges on news, and we'll talk about this a little later. We had a couple of weak bounces. We've seen some distribution. Home builders, which have had a nice run, which were pausing, have had distribution this week. Some of them have pulled down below their 20. We'll have to watch the action. And some of the travel and leisure stocks, kind of mixed action. Airbnb had a nice gap up. We'll have to see it can hold. But Expedia and Booking are a little bit more on the mixed side. Now, I want to talk about the importance of average cost. This is something I think is really worth spending some time on. It's something I had to learn in my trading career to be very, very careful about watching average cost. So on the left, I wanted to talk about the situation if you're in stocks or playing stocks that have come off 50% more in corrections, very deep corrections. There's a lot of overhead supply. Now, if a stock comes up and has a little prior uptrend, let's say the stock bottomed at 50 and it came up to 65, you're still way off the highs, but it might make a base, a constructive base. So let's say it makes a 15% flat base. Now, that's a different setup than stocks that only have corrected 20 to 30% off their highs, where a 20% off the bottom gets them very close to forming a handle that is within the range of being close to the all-time new highs for the stock. So different situations, and we're going to look at how you handle average cost. So the first situation is stocks that have had deep corrections, and there are many of them out there coming off a bear market. So let's assume a stock was at 100 during the bear market, it got cut in half to 50. So the stock, we'll say, has had a 25% uptrend, and then it's formed a 15% deep base. So if you made your first buy, let's say you made your first buy coming out of a small handle, let's say you buy a 5% size position at $55. Stock keeps moving up. As it moves up, you get excited. You make your second buy. You buy another 5%, and another 5% gives you a 10% position, and you now bought that at $65 per share. So now you have an average cost line of $60 per share. Now, when the stock comes back down to form this base, you can just see how you're going to be under pressure. So what's interesting is, this base is forming within a much larger base. That's completely normal when you've had large bear market corrections. So in this example, it's dangerous because what you've seen is, your first buy As the stock has come back down, is break even, and your second buy is underwater. You've taken a 15% loss in the second position. So the whole position is just too top heavy. It's all messed up. You added too soon. Let's look at another scenario. So here's a stock that's only maybe 20, 30% off its highs, and a little bit more of a constructive situation where you're perched for new highs. So let's assume it makes a 20% move. You're trying to get an early entry. You got a little handle to enter. You make your first buy at 88 and you take a small position size, 2.5% size. And the stock moves up, and it really moves up strongly, moves through the buy zone. And you really start to believe that this breakout is going to work. Breakouts have had a tough time in the bear market. You say, boy, this is really working. I'm getting excited here. I want to add some more. So you add another 7.5% size, but you've actually did that above the 5% buy zone of the pivot. So now you have an average cost, a new average cost of 104. Now the stock comes back in normal action and pulls back. And again, you're under pressure. Even though it's pulling back to within the buy zone, you're going to get stopped out here because you've got a 4% loss on the whole position. So you're again under pressure because you're just out of position. Now you'll note research shows that 40% of all breakouts will pull back to the pivot. That pullback to the pivot is completely normal. If you were positioned down here, this wouldn't bother you. But since you got excited, you raised your average cost too quickly, you can see the pressure that it puts on. And particularly if you get stopped out and the stock really starts to make a move, that can hurt. So I wanted to talk about how you can put on size in a base without really adding risk. So here's the situation. If you're going to buy a small early entry, a buy, let's say you're going to use a 6% stop, and we'll use a dollar stop, say, of about $1,000, which represents 6%. You make a buy. Stock moves up. You see a consolidation. Things look like they're going to move higher. As it starts to break out of this little pivot, you decide you want to double your position size. So you go from a 5% position to a 10% position. But this is important. You need to tighten your stop. Your new stop loss should be 3% versus 6% because you want the dollar amount of loss and risk to be the same. So you essentially have brought up your average cost, you've doubled your size, but your stop is controlling your risk the same as it was on your initial position. Now, what becomes important was between these two buys becomes really important is the distance between the two buys. You're probably, depending on the stock's volatility, you probably want at least 5 to 10% between these two buys in order to get an average cost that isn't going to get you into trouble. So let's look at an example on a real chart. This is Enphase from 2020, a volatile stock. You can see we're trying to buy in the base here. We see a consolidation. We make our first purchase here, and we put in a stop loss at 6%, risking $1,000. Stock starts to move up, it comes back, consolidates a little bit, then it starts to move up. So we decided we're going to make our second buy. We make our second buy, clearing this resistance. And now we've taken our stock and we've tightened the stop to 3%, half the stop, percentage stop, to keep the risk at 1,000. And our average cost has come up into this level here. What's important is now we have average cost that in this example is 22% below the common breakout pivot, in this case of 59.15. So this allows you to get a position with some decent size, and as the stock breaks out, you don't take this buy here because you're positioned away from the crowd, which gives you some cushion. And when you have this volatility around the breakout point, your average cost is down here, so you can actually survive. So that's just a quick example of one way that you can add size with controlling your risk and trying to avoid breakouts. So I wanted to talk a little bit about when sometimes good is not good enough. You'll sometimes hear people say, why did my stock drop hard? There wasn't a lot of news, or geez, the news sounded good. What happened? You'll see situations where you get an earnings report that met the forecasted numbers, and you say, well, why did the stock drop? And then sometimes you'll get earnings reports which are terrible, and the stock actually gaps up. The important thing to remember is it's the reaction to the report is what really, really matters in the market. Now, sometimes it's going to make sense to you. Sometimes it's not going to make sense to you. Your personal reaction to the news and the report means nothing. If you liked the report or didn't like the report, that means zero. What's important is the institutional reaction. That's the only one that matters because they carry the big stick that drives stock prices. Now, institutions have all kinds of valuation models, spreadsheets. They do a lot of deep research, have teams of analysts looking at these companies. And sometimes they're looking 12 to 36 months ahead of traders like us. Now, it takes weeks to months for an institution to build a position. So they may be buying a stock that looks weak to you, but they're looking at it because they say in the next 2 or 3 years, we really have the research that shows the stock is going to be more valuable. They may see a bad future for a company or a good future, but they're looking out further than you, and they have deep research teams to do that. So don't let your personal reaction to earnings report cloud your judgment. We have to follow the institution, and if they're showing us that they don't like the report and they're going to sell, we have to really, really be in line with that. Now, just want to touch about a couple things that happened this past week. For anybody in Credo, it's really an unfortunate situation. The stock was acting really, really, really well. And then they had some news about one of their customers was going to reduce some orders, and it's a significant amount of their revenue. And the stock plunged badly on that news. And there's nothing you can do about that. I mean, this is a black swan type of event. There's nothing you could do. It was not seen in the chart. You just have to really probably best just to sell your position and move on. These things, if you trade long enough, this stuff is going to happen, and it will happen to you at some point. Luckin Coffee collapsed in 2020. Crocs in 2007 around Halloween had a bad gap down after hours on an earnings report. I was actually in that stock, and I can give you a whole list of others. If you trade long enough, once in a while this will happen. You should just move on, try to sell, and regather yourself. Shopify was a situation where they had a good earnings report. You exceeded the earnings and sales numbers, but institutions did not like the guidance. They don't like what they see. The stock dropped 15% in one day. This stuff happens. I was in shop. I still have a position in shop because I had some cushion, but you have these things happen, and you just have to move along if you have a loss that's exceeding your risk level. So, the great Mark Douglas, who's no longer with us, if you haven't read his book, Trading in the Zone, highly recommend it. 5 points he makes, which are key, is he says, look, anything can happen in the market. Number 2, you don't need to know what will happen next. This is a game of probabilities. And he says, if you've got some edge, you're going to get a random distribution over your trades, over your wins and losses, that if you have a winning positive edge, you'll come out okay over time, you'll be okay. Now, your edge is a higher probability in your favor that something will happen. And remember that every moment in the market is unique. Don't beat yourself up for a situation like that. There was nothing you really could do. So Mark Douglas says it best. Now, Mark Douglas, I think if you go to YouTube, you can see some of his videos of workshops. His book wouldn't say this next slide, but he does say it in the workshop. The quote of the week is, all it takes is one a-hole to screw up a perfectly good trade. Remember that anything can happen in the markets, and just stay open and accept it. And all you can do is control your reaction to what happens in the market. That's all the time we have for now. Thanks for joining me. It's February 17th. My information is here if you want to send a comment or reach me on Twitter or email. Thanks, everybody. Have a great weekend, and we'll see you at the next general market update.